Thank you for joining us for another episode of the Dealmaker series. Today, I'm joined by a friend and colleague, Brice Reid. He is Senior Vice President at nFusion Capital. Brice, thank you for joining us today. Tell us a little bit about you and nFusion.
Yeah, thanks for having me again, James. A little bit about me. I grew up, born and raised in Dallas, Texas. I stayed the course and went to SMU. I actually studied sports management and econ, and then I got into somewhat more or less family trade and into factoring and ABL. I've been doing this now for a decade, actually a little over a decade now. The market has changed a lot, and my group that I'm with now in Fusion Capital has kind of helped expand my horizons and does a little bit of everything, but does a lot of things a little bit differently than everybody else as well. We kind of have a focus in the construction space, but while I say we have a focus, we are a generalist ABL and factoring shop. I'd say majority of our clients, a strong majority of our clients are in the ABL space, and then the remaining are in factoring, and that always kind of tapers off into profitability, size, and sophistication as to what basket they fall into. We've been going strong for, I think this company was started 2017, so not that long, but we've had rapid growth and are one of the largest independently owned factoring and ABL shops in the country, if not the largest at this moment in time.
Awesome. Awesome. So I imagine this year has been very interesting, as it is for a lot of folks. Let's talk about the deal flow first. What are you seeing in deal flow? Are we moving up, down, or sideways?
We've kind of gone more upstream on the deals that we are targeting as we've grown. We've come to realize, as every shop does, some of the smaller deals take almost the same amount of work as some of the larger deals. But deal flow has been pretty steady for us. I think most of the rest of the market would more or less probably say it's been a little bit of a slower year and a little bit more up and down. We haven't necessarily seen that as much, but that probably comes with the fact that we've always had a little bit higher of a risk appetite. Our referral sources, for that matter, send us deals that maybe other groups have passed on, or, we are still winning deals against groups that, maybe are a little bit more aggressive price-wise. But maybe we're a little more aggressive or a little more, I'd say, quote, risky on structure. But deal flow has been pretty solid. Every quarter is different. At industry standard, everything slows down in November and December. Historically, for me personally, for whatever reason, I feel like I'm always the busiest. So we'll see if that goes in the holidays. But right now, I've got quite a few working and things in every single industry. There's no specific industry I'm working on right now, more so than others.
That's good. That's good to hear. The quarter is strong. And you mentioned a deal structure just a second ago. What structures are you seeing a lot of right now?
I think this year I've seen a little bit more aggressiveness from private credit shops where they are structuring deals that maybe they were more AR to inventory heavy, where they'll go a little bit heavier on inventory. I think traditionally, 2-to-1 AR to inventory is pretty standard for ABL. And I've seen groups, including ourselves, go 2-to-1 inventory to AR. And obviously there's some metrics we like to see hit before we put a structure together like that. And it depends on what the collateral is in that scenario. But I think industry-wide, to be competitive and aggressive, which we decided around this time last year that we wanted to be, winning more of these deals with structure, I'm seeing everybody do it based on just coming up with more inventory. Some of the groups that maybe were quieter over the past few years since COVID have kind of come out of the woodworks in hiring some really good players to be active in the market again. Structure-wise, I think it's been more aggressive than usual. Deals that will pencil as factoring, I've seen some of the private credit shops come in and do them as ABL and price them as such.
Interesting. Sector industry-wise, are you seeing any trends there? Any particular industries? I know you focus on construction a lot, but are there any particular segments there or any other industries outside of construction that are picking up?
No, I can't say I don't. My background is in construction. Our shop has a name in the construction space, but more or less, I'd say less than 20% of my deals are in the construction landscape. We've seen quite a few, I'll say as a shop as opposed to just me as a snapshot, because, everybody's deals flow is different. And I have been lucky that it's always kind of a spread out group of deals that I'm looking at. It's never like, oh, I'm only getting construction deals or I'm getting like manufacturing or staffing. It's always kind of just a plethora. But I think our shop, we've seen a lot in the CPG and manufacturing space this year. We've had some interesting variables that have played a part in that, but we've had a steady flow. A lot of our deals have maybe been a little bit hairier with the MCA players being out there standing tall and really expensive debt. Nothing specific, I would say, has been coming at us other than maybe some manufacturing and CPG. Construction's been just steady, and it always will be for us. We're always usually everybody's first call.
So I'm curious on my next questions around what kind of elements are impacting deals. And I'm thinking that the tariffs and probably interest rates are pretty big impacts for you guys. What do you think?
Yeah, I think the tariffs have stabilized. I mean, as much as they can, like more or less. I think we had like a quarter or two where we worked through our pipeline or starting out our pipeline, our active deals, and trying to target which companies will be affected and hit the hardest by the tariffs. And we weathered that storm pretty strong. Again, I think it's more or less kind of leveled out, where it's not something that we're having to actively be concerned about. I mean, who knows what Trump's next tweet will be? That always kind of shifts the market, but it usually seems to be pretty short term at this point. Interest rates, as they drop, our cost of capital drops. I think there was a time over the past year or 3 years where private credit shops were not that aggressive, and they've gotten a lot more aggressive in the space. And I think it comes down to the fact that they were sitting on a lot of dry powder, didn't know what was going to happen with the Trump, election. And since they were sitting on so much dry powder, like at some point you've got to deploy the capital, get your, investors their money back or return on capital. And I've seen that this year. I've seen a lot of really aggressive term sheets go out that have been competing against me at rates that I don't think make sense. And I don't think they're risk adjusted, and also structure wise, they're more aggressive than they should be when they're pricing it, in the single digits for a private credit shop, and maybe like they're super covenant light. But those are kind of the largest deals that I'm dealing with. Interest rates have not. I've never had an issue on the pricing side, other than if it's too cheap, it's not going to be the deal for my shop. But no, I think everybody's optimistic that rates will continue to drop, and it'll help us get deals closed.
Yeah, I was going to ask, do you think, at the time of this recording, we just had a rate cut last week. And so I'm curious, do you think if rates continue downward that it'll spur more business?
Good question. If I knew the answer to that, if there was for sure going to be more rate cuts, I probably wouldn't be doing this. I would expect it to happen that way, but I don't know. I'm not a good predictor. Everything's kind of been a toss up this year. I think everybody was expecting rate cuts to happen at the end of the year. That came true. Are there going to be any more? I don't know. We'll see. It doesn't seem like Powell cares that much right now. It sounds like he's probably out the door next year. So who knows what he's going to do? We haven't seen a slowdown in the market. It's maybe have gotten a little tighter from the standpoint of like who our clients are doing business with. We've seen some of those start to shake.
It's an interesting situation. I didn't mean to cut you off. I kind of want to stick on the rate situation just for a moment longer, because as I've understood it, they've begun lowering rates mostly due to fear around the labor market softening. And I'm curious, as the labor market plays a huge role, especially in construction, but just across business,
Yeah.
of any industry. So I'm wondering, like, if you've seen in the past when labor gets a little bit softer like that, does it impact deals, if you can recall?
I can't, because I haven't done this construction space long enough. It's only been 2 years, but I will say that we have seen clients impacted from some of the labor issues, including ICE, whether that be on our staffing side or in construction, where maybe people aren't showing up to work, not maybe even if they're legal, just due to some fear. And I've seen that happen. We were looking at a deal that was a meat processing plant, and I think it was shortly after the election, and there was a field exam going on, and field examiner showed up and none of the employees were there, just based on fear of potentially getting, there was an ICE scare. But I can't exactly tell you what the correlation is there. Sorry.
Yeah.
Go ahead.
What about we'll shift a little bit toward geography here in DFW or Texas. Are you seeing anything that's trending for business there? Are we what makes us unique from some of the other markets that you might operate in?
I mean, I think we're unique from the standpoint of like we have this like bubble around our market where things are really never that slow. Real estate is always pretty strong and firm. I think we're the number 2 financial market in the United States, behind New York, for not two. I'm assuming we're nearing it.
Yeah.
But being in Dallas and that we're central and kind of get everywhere as well pretty quickly, I think that makes us unique too. I see deals all over the country, specifically not only in Texas. I'd say 10 to 20% of my deals are in Texas, but the rest are anywhere else. So I think that helps. I mean, you talk about Preston Center. I think there's 187 banks in like a square mile radius. People here want to lend money.
Yeah. Are you seeing more money, would you say, coming into Texas or going out?
No, certainly coming in. I think
Yeah.
again, obviously there's some mergers and acquisitions going on, but you're seeing a lot of these massive corporations, right? Sprout up here and maybe not just Dallas, but in Texas in general, obviously due to some of the economic incentives there.
Yep. I believe we
We make it a
are.
lot easier to do business in some of the other places like Chicago or LA or New York for that matter.
Yeah.
The regulations,
Yep.
taxes.
I believe we are number one in the number of professionals working in finance and living in our city versus New York. There's more professionals that live and work in Dallas in the financial industry versus New York, I think
Yeah,
is what
it
it is.
maybe it's like private equity and family offices were number two behind New York,
Yeah, it could
which
be.
is you'll probably see some of that also shed to Florida over the next few years.
Yeah.
See what
Yep.
happens with that election cycle too. There'll probably be even larger mass exodus.
All right. Last question. And we're going to look into the crystal ball on this one into the future and see what we can come up with. What shifts do you see coming over the next year or 18 months?
I think as some of these shops and groups have been uber aggressive and maybe a little bit looser than they traditionally were, I think we'll see a little bit of a pullback on appetite for some of these shops. I think rates will probably come more in line with what they should be. When I say, rates maybe go up and maybe just like their risk grade and a little more risk conscious when they're throwing out these facilities and rates on deals that like I would consider risky personally. If I'm going to invest in a facility and it's 8-9% all in as an investor, it's like I feel like there's safer places to park your money, and it only takes one or two of these big 20-30 million dollar deals for things to go south quite quickly.
Yep. Yep. Brice Reid, I appreciate your insights and appreciate your time. Those of you watching, catch more episodes of the Dealmaker series from this quarter by checking out my YouTube and following me on LinkedIn. Brice, thank you, sir. I appreciate you.
Yeah, I appreciate it, James. Thank you.